I put out a video yesterday showing that the price of gold tracks the US money supply much more closely than it tracks the consumer price index. The main point of that video was that when evaluating the attractiveness of the price of gold, one should not use the CPI to adjust past price data to compare against the present price. One should instead use the growth in the money supply. And this makes sense because gold is a monetary metal. For any of you who didn't see my video yesterday, I'd recommend watching that one before you watch this one. And to make it easy to find, I'll put a link to it in the description of this video. Many subscribers asked me about silver in the comments section of that video. I guess in a fit of laziness, I simply responded to the comments that silver is more of an industrial metal and that I noted it does not rise with the money supply the same way gold does. But just to illustrate the point, I put together a couple of slides. In doing this exercise, I noticed something peculiar that I had not noticed before. I'll get to that in a minute. Here you see one of the slides that I had in yesterday's video, but instead of the price of gold, I added the price of silver. The plots of the M2 money supply, currency in circulation, and the consumer price index are still shown for reference. As before, the chart is on a log scale. And the reason I do this is because logarithmic scales are better at showing exponential rates of change. In the log world, a constant rate of exponential growth is shown as a straight line. The steeper the line, the faster the rate of growth. Thus, you can very easily see that the consumer price index in the 1970s had a very similar rate of exponential growth as did the currency in circulation and the M2 money supply. After about 1982, the growth rate of the consumer price index slowed, but the growth rate of the money supply continued at about the same rate as it was in the 1970s. It's a little difficult to see here because the price of silver is so volatile, but when I first looked at this chart, it almost looked like silver's price would overlay pretty well with the CPI curve. To make this comparison easier, I multiplied the price of silver by 30 to move its position higher on the chart. I also added back in the gold price. And let me show you what that graph looked like. And here's the result. Notice that from 1971 through 1980, the price of silver multiplied by 30 tracked the price of gold pretty nicely. Both metals increased in price much more quickly than the money supply and the consumer price index. And part of the reason for this is that up until the early 1970s, the dollar price of gold was fixed. Rampant inflation of the guns and butter era made gold and silver like a coiled spring ready to be released. Another reason is that the price of gold and silver, they move in anticipation of future conditions. Up until when Fed Chair Paul Volcker jacked up interest rates into the teens, those who invested in gold and silver were anticipating the death of the dollar. And finally, another reason for the rapid ascent of the gold and silver price is that momentum traders hopped on the trend and amplified the price move. Of course, we all know how that ended for them. What's really interesting to me about this chart is that after the peak in 1980, the trend in gold and silver price diverged. After the excessive speculation was wrung out of both metals, gold continued to follow the growth path of the money supply, whereas silver's rate of price increase mimicked more closely that of the consumer price index. Now, I'm not exactly sure what this means, so I'll encourage everyone who has thoughts on it to make comments in the comments section. I'm playing around with thoughts of my own, and here's my initial thought. What was peculiar about the early 1980s is that with US assistance, Iraq invaded neighboring Iran, and there was an ensuing 8-year war. Now, why does this matter? Well, it matters because in the late 1970s, Iran was a major troublemaker for the US as far as oil supply and oil prices were concerned. US conventional oil production had peaked in the late 1960s, making the US and much of the rest of the world dependent upon Middle East oil for its energy supply. Now, the 1970s were a turbulent time in the oil world. There was an embargo in the early 1970s, which was catalyzed by the US decision to resupply the Israeli army during the Yom Kippur War. In the late 1970s, there was a revolution in Iran where the Shah of Iran was displaced by the Ayatollah Khomeini. During this time, oil exports from Iran decreased notably. After Iraq's invasion of Iran, over time, energy production began to build. That, coupled with conservation efforts in the Western world and decreased economic activity, resulted in an oil glut. This partly explains why the rate of growth in the CPI curve decreased markedly. Now, there has been much less price escalation due to plenty of oil and decreased economic activity. Now, I don't know if the CPI is a good measure of price inflation. That's not what I'm commenting on here. In the past, I have compared the CPI, which many say is a manipulated figure, to the continuous commodity index, which is not manipulated. And what I have seen is that the current incarnation of the CPI has actually grown faster than the continuous commodities index. And I showed that in a video years ago. I'll have to look for that one and repost it. But back to silver and gold. It looks to me like gold and silver diverged right around the time of the invasion of Iran. And this was right around the time when the CPI curve started to diverge in its rate of change from the money supply. And this all was coincident when oil was freed up to flow and the severe upward pressure on general prices was relieved. U.S. monetary authorities have continued to increase the money supply at the same rate as they did in the 1970s. Gold has followed the trend in the money supply. Silver, by contrast, seems to be following more of a trend in general prices, and that's lagging the money supply. Now, I don't know if this will continue to be the case. I'm not making predictions here, just an observation. For me, I plan to stay in gold. I think it makes sense to stay in the metal that has tracked the money supply growth, rather than to stay in the metal that has tracked the general price level in the same way that other commodities have. Gold is a monetary metal, and will continue to be a monetary metal. The Treasury has made it clear that the physical Federal Reserve notes in existence stand as first liens on Treasury gold. So long as the Federal Reserve continues to create more of those, I'll take the gold. Thank you.